This is the second part of a two-part video that describes why our nation will fall into a credit crisis. In the first video I mentioned entitlement. That's Medicaid, Medicare, and Social Security. These figures are taken from the Congressional Budget Office's numbers, and you can see how they're going to continue to rise through the year 2015. In fact, in the year 2015 they'll hit about $2 trillion per year. Now what we're going to do is we're going to figure out what the government's total revenues are, and we're going to subtract out this figure, and then we'll have some excess left, and that excess will help us pay for interest on our national debt. To calculate the tax receipts, I've taken a few assumptions. I've assumed that GDP will grow at 4% during the next 5 years. Now mind you, during our best economic boom recently from 1995 to the year 2000, GDP grew at 4%. Over the last 80 years, it's grown at 3.4%. So this assumption is saying that we're going to have fantastic economic growth of 4% for 5 straight years. As a percentage, during the last 10 years, from the year 2000 to the year 2010, tax receipts have averaged 17.6% of GDP. So that includes some great years and some bad years, but it's been 17.6%. So we're going to use that number and these growth rates. If we do that, and we subtract out from those tax revenues the entitlement expenses, you can see what we have left over. And I call this interest surplus. So this is the amount of money that we can afford to spend on interest expense on our national debt. Now each and every year our national debt is going to continue to grow. In the year 2011, our national debt is going to hit $15 trillion. Again, this is publicly available information. And according to the Congressional Budget Office, our national debt will grow about $800 billion each and every year for the next 5 years. Now, I've added a little bit of cushion in there, and I've said that our deficit each year would be $1 trillion. And I feel that that's not even that's still a conservative number, because we have a number of huge outstanding issues. Fannie Mae, Freddie Mac could be an $800 billion program. Student loans could be $1 trillion problem now that the government is doling out student loans. State deficits, I've heard, could be $1 trillion in a recent report that was done by Meredith Whitney, one of the best minds on the street. So I've added a little bit of buffer to keep the numbers very easy to work with. We're at 15 trillion, we will go up to $20 trillion. So now we need to figure out, if we had that interest surplus figure that I showed you earlier, and I figured out that's how much I have to spend, what interest rate can I afford if we have a $20 trillion national debt, I can figure out an implied interest rate. And that's exactly what I've done. So in the year 2011, next year, if our interest expense on a 5-year bond rises to 7.6%, we will be able to cover our entitlement costs and interest on our national debt. Nothing else, just those 3 items. And the reason that I used yields on a 5-year bond is that our average maturity on our nation's debt is 4 years. So that means that we have very, very short-term loans that we have to keep rolling over and rolling over and rolling over. Our nation is very, very vulnerable to rising interest rates. And you can see here that each and every year as our debt grows, the amount of interest that we can afford on that debt continues to decline until in the year 2015, if interest rates go above 6.4%, we can no longer afford to pay Medicare, Medicaid, Social Security, and interest on our national debt. Very, very scary, because 6.4% is nothing. This is a chart taken from the Treasury Department. It is the yield on a 5-year bond, and you can see back in the early 90s we were way above that level. We're up around 8%, came down a little bit, back up around 8%. Even in 2006, 2007, we were almost up at that 5.5% level. Very, very close to our tipping point. This red arrow represents where we could go right now as far as interest rates and still afford it. And this red line here would actually extend out off of the chart, but it shows you how dramatically that level is falling, the level that we can afford. You'll also see how interest rates have recently spiked, even at a time when the Fed has been trying to lower interest rates. So what can we conclude from this? We are definitely on a crash course. That interest rate continues to come down and come down as our debt increases, and it's just a matter of time until it falls even lower than 6.5%. In addition to the mandatory expenses that we spend money on, we have about $1 trillion plus, actually $1.3 trillion recently, that we spend on defense, justice, homeland security, education, transportation, veterans affairs, lots of other vital programs that our country depends on. We're going to continue to spend that money. It's going to continue to drag us further and further and further into the hole. So you can hear about all these fantastic cuts, like the $100 billion that's going to be cut from defense spending. That's wonderful and it needs to happen, but it's not going to address the issue. We can't afford our entitlement and interest on our national debt. So each and every year the probability of default increases as the interest rate ceiling declines. The market's not going to wait for the flashpoint to be reached. It's forward-looking, and if it senses default risk, all of a sudden you'll see investors starting to move money out of U.S. bonds, and as they do that, interest rates will start to spike higher and higher, and it will be more and more difficult for us to refinance our debt. That's exactly what's happened in Greece. It's happened in Ireland. It's happening in Portugal right now. Interest rates in Spain are starting to creep higher. In fact, in Spain and Italy, their interest rates on 5-year bonds are already up above 5%, and they've been moving steadily higher. Not because their economies are improving, not because of inflation, but because of risk. I believe the problem will start in Europe, and it will quickly spread to the United States. The underlying theme here is you need to be prepared for tough times. At oneoption.com, we trade options primarily, both bullish and bearish positions. You can subscribe to my research and analysis, and I will be prepared for that crisis when it comes. Thank you for listening.